The title "Searing Insight" would be a great title for a podcast.
I'm all sizzle. I'm no steak, Diogo. You know that.
So you're all seer, no insight.
Our seer, no
Yeah,
insight.
yeah. So before we get into it, I need to give a disclaimer for our GC Chief Compliance Officer James Rathbell. This is anything I say after this is not financial advice. We and have an investment in the company that we're about to talk about, Euler. But I figured this would be a good chart for us to discuss. So earlier this week, Euler hit a big milestone for the protocol, which was $1 billion in assets in TVL. Obviously, looking at this chart, we can see that it was not a straight line to get there.
That is a euphemism if I've ever heard one.
Yeah, I mean it's been a long road for the team, and I think I can think back to March 2023 when the protocol was hacked. It was for us the week after SVB and all that drama, where we had literally spent a week dialing for dollars for all of our portfolio companies to get just bank accounts. And then we got back to the office the week after and we got the phone call that something like this had happened. And we are like, okay, here we go again. Let's see what we can do to go to work for the team. And it took a couple of weeks, but the team was able to get all the funds back from the hack and return them back to their users. And I think that was a big reflection period for the company. A lot of teams probably would have just keeled over. But the team made the long-term decision that they wanted to come back and they wanted to come back stronger. And it was quite the uphill battle, as you can see by the graph. But, they far exceeded the expectations from where they even were back in 2023 pre-hack. And so I wanted to take a moment to just give them a shout out and have a venture investor sort of portfolio moment for them. Cause I think this is pretty freaking amazing. And something that I think most teams wouldn't have been able to pull off. And I don't know, it brings a lot of kind of observations to mind. And one is that having a long-term orientation and being committed to a market and being committed to a product can really go a long way in crypto, where there's a lot of where there's a lot of noise, there's a lot of short-term activity. Just having a longer time horizon and having a team oriented around, seeing through the noise can really go a long way. And so I just wanted to say kudos to the Oilers team for this one, because this is something that I don't think you see very often.
That's amazing. That's amazing. Do we know where the demand is coming from? It seems like a pretty steep growth. Is it mostly whales?
Yeah, it's been a different go-to-market motion too. So originally, Euler, was a lending protocol that lived on Ethereum L1. And there wasn't too much exotic motion that you had to do to go to market. Now in 2025, you can't just go to market on Ethereum L1. You have to be willing to be more proactive and go to new chains. And I think that they've shown that they can not only build a better product, but they can exercise different go-to-market motions and be more creative and proactive to find sources of TVL and go for some of the newer DeFi protocols. Things like Usual, which is a new stablecoin protocol, has been a large driver of some of their TVL, but they've also been very active on new chains like Sonic. And so I've just been impressed kind of across the board at the persistence and also ability to get creative to find and do the right BD things to get the TVL on the protocol.
How do you feel about a graph that supposedly directly correlates to usage? In this particular case, you have a graph of TVL, and there's a graph that is hidden, but that is represented by one number there, which is a FTV of 180, that basically hasn't budged. So it's kind of or it has gone up. I think, at lowest, it was actually under 100 million. And the price was 2 point something. So it's 3x over the past few months. I believe that's what's happened. But it's kind of like $170 million of FTD. Do we believe that kind of like this is a fair market value? Do we believe that this action should not have a corresponding action on price? I'm very curious to hear about how you think about the TVL versus FTV, and if the market is recognizing this as a win.
Yeah, I think it's quite clear that the market does not value TVL in the same way that it did in 2022 and 2023. So we're at all-time high for TVL by a factor of 2, but the price is down. I mean, it's not, it doesn't show it on this chart, but the price is down from 2022, 2023 levels by, you call it a similar order of magnitude, 2x, I think. So clearly the market is saying either we don't value TVL the same, or the market is just mispricing it. I think it's probably fair to say that TVL is viewed more now as a vanity metric than it is as a core indicator. But for the sake of this conversation and the sake of the work that I think Euler has done, it's still fair to be a badge of success for the protocol relative to where it was 2 or even 3 years ago. I don't think that there are really great standards for how to value governance tokens for DeFi protocols today. So I don't have any like searing insight for this is the multiple that you should take, or this is how you should think about it. I do probably think that Euler is undervalued relative to the progress that they've made. But by how much, I'm not exactly sure. And I think there'd be false precision.
The title "Searing Insight" would be a great title for a podcast.
I'm all sizzle, I'm no steak, Diogo. You know that.
So you're all seer, no insight.
All seer, no insight. Okay, let me take this over. This is a great graph, and a great kudos to the Euler team. I'll take over and be more of a little bit of a Debbie Downer.
Oh no.
I mean, it's not a Debbie Downer, but the graph that I brought today is this graph, which is known to essentially everyone. What the graph is showing is this is RWA.xyz, $20 billion of RWA assets, which I'll say until the day I die that RWAs are a terrible name for these things. There's no other world in the real world, and so why would we call these real world assets? But, diatribe aside, RWA value has been up and to the right. This is considered to be a major success. People are touting that this is actually fantastic for the space and showing this graph to everybody that is willing to talk to them and listen to the crypto folks. However, looking at this graph, the immediate thing that comes to mind and that is immediately obvious is the fact that private credit is $12 billion out of the $20 billion. And so 60% of it is private credit. And then if you click private credit, you immediately see that the large majority of the private credit is a single thing in purple called Figure, which is built on a Providence blockchain that has, yes, a public zone, but primarily is known for being a permission blockchain that has a bunch of private stuff. Funnily enough, right now as this protocol, Tradable is number 2 that is actually built on zkSync Era and has been growing massively. But even that, if you look at it, is a major discontinuity in terms of how it's actually come up. You can see it here at the bottom. In black, Tradable going from like 0 to $2 billion FTV. And so these two represent the large majority by more than an order of magnitudes of the volume, which then means that when we're looking at the market overview, of course, and we look at this as a major success, we're basically talking about, hey, Figure is the large majority of this growth. So for me, I just can't help but look at this thing and say, okay, cool, this is fantastic. We have $4 billion of treasuries that are tokenized. Fantastic. Those are yielding dollars. We have $1 billion of commodities. Fantastic. Everything else is sort of like, okay, private credit. And it's not a great story still, if you dig into the details.
Let me try to inject some silver lining into this
Let's do
doom
this,
cloud
please.
that Diogo is introducing here. So I think it's a good point, and I think it's important to double click and dive into what these charts show, what these numbers are. A couple of observations. So I think we could have said the same thing about stablecoins. So you double click into stablecoins and you realize that the entire market is Tether and a bit of Circle, and all the others don't really matter. In fact, actually, a couple of years ago, maybe not even a couple, maybe a year or two ago, if you would have double clicked into the chains, you would have seen that it was all Tron, and you could have, I think, said a lot of doom and gloom. All of these things are true, but I think it's still undoubtedly true that stablecoins are going to continue to grow. There's tremendous potential for them. Same thing with tokenized assets, and this is just the start. And so that's observation number one. Observation number two, I wonder if actually this is a success case for how different companies can start to do this, which is, can you actually create a verticalized product? And so instead of just deciding to tokenize an asset and just, spread it on every blockchain and hope for the best, can you actually create a product that really integrates tokenized assets into the value proposition and the offering of your product, and then grow it that way? And so, I know Michael Tannenbaum well. We used to work together a long time ago, and I've talked to him about Provenance and how it's basically a permission chain. For the purposes of what Figure is doing, I think the chain is just transparency, auditability, making sure that everything is on one legible ledger. So maybe it serves its purpose, but coming back to the point, I just wonder if having a more verticalized product is actually one way that you can start to grow this market.
I would throw it back at you as well, Diogo, and ask you if is Hyperliquid a permission chain, and is like Hyperliquid bad for the ecosystem? And does that reflect your mental model for Figure?
Well, I don't think it's bad for the ecosystem, and I also don't think private permission blockchains are negative for the ecosystem. In fact, I think they're positive. They're much better than just like non-transparent databases. So if everything moved on chain in this form, I think that would be much better. So I think that's a fact. So if I take that, that's a major silver lining, which is it's a use case that is transparent. If you look at it from a utility perspective, for them, there's not that much utility outside of trying to bootstrap their own network and trying to get network effects into their chain. And not everybody's going to do that, because not everybody's going to try to go for their layer one and try to bootstrap and own the substrate and own the infrastructure. So there's limited utility. And so it doesn't feel to me like it has longevity, in that the next N+1 set of companies that are going to do this type of private credit aren't necessarily going to use this on chain, because maybe the advantages haven't been proven out to me that they're actually it's better infrastructure. Maybe it is. Maybe you can claim that the tools and the explorers and all of these other things that get built around it create some sense of value. Sort of like DeFi has a lot of value, and anything that integrates as an ERC20 token or whatever immediately benefits from all these market makers and all these pools and all of these lending protocols. Maybe there is some of that for the infra, but it's a very tenuous advantage. And the thing that bothers me the most is just it's a big difference, right? It's $20 billion.
Yeah. It feels misleading. I think maybe the thing to point out is it feels weird that they're cobbled together. On L2 Beat, you can see very explicitly this thing is actually a roll up. This thing is not a roll up. This is stage 0. This is stage 1. This is stage 2, and we're lumping all of them together. And really, when we talk about RWAs, we're talking about the 24/7 accessible, globally accessible, permissionless, running on a public chain that anyone can compose a liquidity with, not this shared database with extra steps, right? And so I think the rosy way to picture it is that Figure is a gateway drug into actual permissionless blockchains. And I don't know if Tannenbaum thinks about it that way, but I think that's the incrementalism into it is that, okay, we're a large financial institution. We want to open things up step by step, and then we'll learn along the way that we're kind of using the kneecapped version of it by only doing in a permissioned way. But then we can actually tap into a more permissionless, globally accessible pool of liquidity if we actually go straight to a layer 1 blockchain or a layer 2 or something like that, and not do the half way. Can we cuss on this? Is that chill?
Yeah, it's chill. You can say whatever. You can always bleep it later. And the thing that bothers me is that this opens up, every time we're talking about this, somebody's going to look at that chart, and it's going to be very easy for them to do 2 clicks and then realize that the majority of the growth and the rate of change, by the way, that is dominating are these private credit.
It's something else. Really. It's something else.
So anyway, it's slightly bothersome in my worst days.
If you run RWA.xyz and you're listening, we've got a bone to pick.
We don't. I mean, maybe we do. Maybe we do. Some engagement farming works, right? We have a bone to pick. Chris, you're up next. Show us what you got.
Mine's related. Before I share my screen, I'll lead with a question, which is how many of the top 25 companies by market cap, these are public companies by market cap, do you think are in the United States? Or are American companies? How many of the top 25?
80%?
Breck?
I know the answer because we already talked about this, but I'm going to go with
what would you have guessed?
Finger in the air, 23 out of 25.
Pretty close. I wonder how you got that number. It's 22 of 25.
Oh.
So pretty close. Pretty close. Actually, Diogo, you're actually pretty close, and it was a legitimate guess.
Yeah. So I was trying to think which European companies I know that actually, I mean, it's a little bit unfair because culturally in Europe, like some of these companies are kind of like, held privately and whatever. But yeah, so that was the mental model.
Zero European companies, but there would be if you had what do you call it? LVMH. What's the parent company? Yeah. It would be up here probably. But it's 22 of the 25. The three that are not American is Saudi Aramco, it is TSMC, and it's Tencent. And the rest are American. I will caveat by saying if you expanded this list to the top 50, there are definitely more international companies. But just look at the top 25 of the biggest public companies in the world, and 22 of them are US companies. And actually, this is relevant to the conversation we were having before about RWAs and where are we seeing the growth of tokenized assets, because I think one of the benefits that we've all talked about internally here is how do we create a global accessible market for everybody. One flip side of that, the other way to think about that is what are the assets that people don't have access to that they may want, and who are these people and what are those assets? And if you're somebody that's not living in the US and you want access to some of the most successful companies in the world and their equities, it's hard. I mean, in the US, you jump through a couple of hoops. It's doable. When you're living abroad, it's really not easy. And so I think these are the types of opportunities and the assets that people can really start to take advantage of. I don't know, Diogo, I mean, you live in Lisbon, how you know this probably better than most. What do the steps look like for you if you were trying to buy US equities?
Yeah, so in my case, obviously being American means that I can't actually just open a brokerage account, so it doesn't count. But I help a lot of my friends, especially the ones that are not as financial minded, through the basic financial literacy, buying ETFs, diversification. I tell them just get exposure to the United States, buy QQQ, buy S&P 500. And it's actually it's surprisingly hard. It's getting much easier with, the Revoluts, the eToros, these types of European focused Robinhoods. But one thing that I've realized, which is kind of funny, is the majority of them are still in this phase where you search for S&P 500 and they show you a CFD, which is basically a 20-to-1 leveraged bet on the S&P 500, just because it makes them a lot of money. And they hide away the S&P 500 index score somewhere else with very high fees, number one. But it's still non-transparent. People don't know about it. And they're definitely taking advantage of a lack of literacy in Europe, because I have lots of friends in which I literally said, buy S&P 500. They search for 500. The only thing that appears on the list is leveraged 20-to-1 bet, and they buy that thing. And then they send me a screenshot. And I'm like, no. That is not what you want to buy. So that is happened more than once.
They're prepping for crypto. They're prepping for crypto by doing that. They're familiar with leverage.
So the interesting thing, by the way, is that there's all these rules and regs, and a lot of the reasons why this is so hard, obviously, is regulation on both sides, right? European companies don't want to have Americans, because once they onboard an American, for example, they have to meet a different compliance burden, and they have to submit stuff to the US. And the United States folks don't really want people that are international, because the US has so many regs about people living abroad and what they can and can't access, and how you have to split it across the board. So if you find a population that is less profitable and requires more compliance costs, then all of a sudden this goes down. So this is another mark towards the global first of tokenization, right? That kind of creates a uniform platform, reduces the barrier of entry, and to a large extent, I would still claim there's regulatory arbitrage, right? So that's actually what's happening is the combination of those things.
Can we go back to the RWA.XYZ chart and see what percentage or what is the total dollar amount of commodities on chain? Because I see this chart,
It's
Chris.
about $1 billion, I believe.
Why isn't it more? Yeah. Why is it not? Like, what has been the like inhibitor to adoption? If all of these companies are US based and listed on NYSE, NASDAQ, etc., and if you're living abroad, it's not that easy to actually get exposure to. Like, why is this not a bigger market, and why is this like relatively failed compared to stablecoins? Like, why can't you just create a like America fintech app, sell it abroad, give people the MAGA hat that comes with it, and they can own dollars, they can own an index of the top 25 American stocks. Like, why doesn't that exist?
If you buy it,
yeah, exactly.
If you buy a gold card, it comes in the mail. My theory for this is that I think we're going in terms of asset category. I think we're going from simpler to understand to more complex. And right now we're in the simplest form. The simplest form is a dollar. Like, it's very easy for everybody in the world to understand what you're getting with the dollar. I think it's also very easy to understand what you're getting with the US Treasury. You don't really need to underwrite the risk. If you believe the dollar, you believe the Treasury, right? Like, no extra steps required, and you're just getting more yield for it. So I think that's a no-brainer. And then from there, you have to start to evaluate what the risk is. And, commodities has its own set of risks. Private credit will have its own set of risks. Equity is even harder to understand because the return is variable in addition to underwriting the risk. Once you start to get into, esoteric assets, you have to underwrite even more risk, and you have to understand a very niche segment of the world. And so my theory on this is we're going to get to more complex, like it always does. But we're starting with the simplest stuff because that's the easiest thing that people can understand, and that generates the easiest demand.
That sounds reasonable to me. It is fascinating, though. The majority of it is all gold, right? It's tokenized gold, which, by the way, it's easier to access to in Europe and because it's not locked inside of another country. Which again, I think it's also part of like my chart, which is why is this all private credit? Yeah, why don't we have more of this?
I think it's a really important thing to call out that for tokenized assets, it actually feels like the technology offers benefits, but really the long pole in the tent is going to be the regulatory stuff. And now that the technology it makes it so easy to have a global user base. And there are definitely pros to having global access to these assets. I think you get a much more liquid market. You'll create more demand for these assets, which I think is a good thing. Obviously, it comes with increased complexity and AML, KYC requirements. The legacy infrastructure that we've all built is really in service of this. Like, it's actually meant to slow you down. And so I think it'll be interesting. And I don't have a great answer for this on how we actually deal with this contention.
Yeah, I mean, look, the fun fact, if we put all of our first funds into the RWA market without accounting for private credit, we increase the whole market by 30%.
We could move the market.
Hey, what I'm hearing is that crypto funds are not only becoming fintech funds, they're also becoming American Dynamism funds because we're investing in the American market. Like that is kind of what we're going to be doing with RWAs. Like, this to me seems, that chart is actually very clarifying, Chris. Yeah. And I'm becoming more excited about the equities opportunity, I think. Just like from that simple frame.
The same way that we say stablecoins increase the dominance of the US dollar, RWA and tokenized stocks are going to increase the dominance of the United States market.
Totally. The simple mental framework for this is just supply and demand. The demand is going to come from abroad, and the supply of assets that generally people think are interesting are coming from the US mostly. And so if you're the US, it makes so much sense to actually open these things up, obviously to the extent that you can protect national security and not fund terrorism and all of those things. But the pros are I think, pretty tangible.
Yeah, that's pretty cool. That's a pretty cool thought process. Same way that the stablecoins increase the dominance of the United States dollar in the reserve currency status by exporting RWAs, specifically tokenized stock, and opening it to the world. We're exporting the dominance further of the United States.
Even the private credit, right?
Yeah.
Credit
True.
is going to be determined by how safe and how enforceable do you think this is, and the best place with the rule of law is the U.S. It's like how much,
if you're a company in the U.S., you're going to have a lower cost of borrowing because there's going to be global demand for your credit. No, 100%. I like this framing. We should write a blog post about this. I think that'd be pretty popular. So people have the narrative of like the stable coins, expanding the dollar reach, but I don't think anybody has written about how RWAs actually expands the reach of the United States industry.
I'll write it.
I like this framing of like
why crypto funds are an American Dynamism fund.
That's right. Why crypto makes the world an American Dynamism fund or something of the sort. I love it.